The Fed finally cut rates. Mortgage rates went up? What's up with that? So, well, the Fed cut rates by more than expected, 0.5 point at their recent meeting. And buyers expecting mortgage rates to drop are disappointed. What the flip? Chairman Powell did not swoop in to save the day? What happened? The rate reduction was widely anticipated and, as we say, baked into the cake, baked into the market and pricing already. Mortgage rates often seem tied directly to the Federal Reserve rate cuts, but in reality, they respond to a variety of factors, sometimes in unexpected ways. Recently, despite the Fed cutting rates by 50 basis points, mortgage rates actually increased. This may seem counterintuitive, but it highlights the complexity of how mortgage rates are determined. Let's break it down. I'm Sally Daley from the Daily Group at Douglas Elliman. We're going to talk about it right now. The Fed rate cuts primarily influence short-term rates, like those on credit cards and auto loans, rather than long-term rates like mortgages. Mortgage rates are more closely linked to the yield on 10-year Treasury bonds. When investors feel uncertain about the economy or expect inflation to rise, they may sell their bonds, which drives down their price and increases yields. Mortgage rates typically follow these yields. In this case, fears of long-term inflation and economic uncertainty have driven investors to demand higher returns, leading to increased bond yields and, by extension, higher mortgage rates. Even with the Fed's cut, concerns about inflation, strong wage growth, and rising home prices may continue to push mortgage rates up as lenders try to protect their margins. And another factor is lender risk. Higher inflation can erode the value of mortgage returns over time, so lenders price this risk into their rates, making mortgages more expensive. So while the Fed rate cuts can influence the broader economy, mortgage rates live in a world of their own, often more dependent on investor sentiment, inflation expectations, and economic insights than on direct Fed actions. So what is the lesson here for buyers and sellers? As we've said before, Big Daddy is not coming to save you, me, or the real estate market. Rate projections through next year are for rates to effectively hover where they are now. Buyers, jump in, the water's fine. Inventory is up in many markets. Less buyers means less competition. Besides probably not having to pay full price, you should ask for a rate buy-down contribution at closing from the seller. Sellers, proactively offer a rate buy-down contribution in your listing marketing to attract buyers pinched by affordability who are now on the sidelines. Your rate buy-down may be the only reason your house sells. Comment rate buy-down below if you're a buyer or a seller who wants to talk more about this strategy and how to seize control of the market and not wait for something else to happen. Until next time, I'm Sally Daley of the Daily Group at Douglas Elliman in Vero Beach, Florida. Take care.